Hello and welcome to our web chat with Brian Shanahan, CEO and founder, Informita Termscheck, and we're going to be discussing accounts receivables, getting the basics right. Now this web chat came from Brian's comment on our 7 steps in receivables automation. He commented, yes, but it's all very well automating, but you need to get the basics right. And if we look at your slide here, the 7 steps to heaven, what do you mean about getting the basics right?
Well, I think that the point of this slide is that there's a lot of things to get right, which automatically infers there's a lot of potential for getting things wrong. So if you think about this in theory, if I have everything right from the start of the chain, all the way in the sales process, all the way to the end when I get my money, I'm making my process much easier. But it's very easy for people to trip up on things. A very good example these days is if you look at lots of the internet companies, very often they get paid their money up front rather than they have to wait for payment terms and so on and so forth before they find out they're getting paid late, as many small businesses find out. And that's why if you look at the stages in this particular diagram, if you look at the chevrons on the top, I mean, if we start off with, sales and quotations, I mean, effectively it's what is your business model? So an example of this would be if you look at payment methods in the bottom of that chevron, if utility companies like to have you pay on direct debit. Why? Because they deal with millions of transactions and it makes the collection process extremely easy for them. And they do that very well, actually. Another part of this might be if I'm in construction and I produce poor contracts. That's an industry where they usually have some kind of stage billing and things like that. So it's important to get that contract right. So it's very important that how I set up the transaction is correct before I've even done any work for whoever the customer is.
It's getting the process right before you automate is essentially what you're saying.
Yes, yes, and when you do have your process right, then it gives you a lot more avenues to do that kind of automation.
What do you mean there? For example, in credit and risk, does that same thing apply?
Yeah, I mean, an example would be if I'm calculating credit limits all the time. Credit limits should be updated every so often, and many companies now have links to the credit information companies such as D&B and Experian and others, but they still do the actual calculations manually. That's the kind of thing where automation can be helpful, and it also helps in terms of, we're not operating necessarily with a credit limit which could be out of date. This company might have been great 6 months ago, maybe they've deteriorated since then. So that's something that if I get that wrong, I could end up doing business with a company who can't pay me.
Okay, so moving through the process, what is the key things in order processing?
Well, order processing, it sounds relatively straightforward, but again, leading from our start in terms of contracts, our payment methods, how we do quotations for our customers and so on. Now at the order entry level, we need to make sure that, one, we're doing that correctly and we have systems that are capable of doing that. And that all flows through into, I suppose normally what we call customer service type activity, but ultimately then does that mean that the product is going to be available, or service as the case may be, to make sure that the client will actually be satisfied with whatever they're getting. So this is the stage where we internally are determining exactly what that's going to be.
And the same sort of thing applies in invoicing, because there are some big areas where you can cause yourself real problems. Oh yeah.
I mean, I was actually just talking with a company just about an hour ago, and one of their issues is that they send a pro forma bill, and then very often there's a credit note off that, and only then can they kind of send a final bill. But it means they have a delay built into their process. So when you talk about billing triggers on here, they can't actually produce the final bill sometimes for 7 to 10 days after they've shipped the goods. Now, another probably more regular thing, at the end of this particular chevron, you'll see billing dispatch. One of the biggest reasons why major companies get paid late is oftentimes because they actually sent the invoice late. And very often that's nothing to do with the customer or whatever their process is. I simply haven't sent them the invoice yet. And part of that is people sending invoices in weekly and monthly batches and things like that. So they actually cause their own delay potentially.
And collections is also again, considerable areas to not get the basics right.
Yeah, I mean, the main thing if you walk into a collections department and you see a bunch of people on the phones and so on, is you want to make sure that they're actually calling the right people. Now, we'll talk about this in a little bit more detail on the next slide, but that's why this point about customer segmentation is very important, because it's very easy to be very busy and not getting very much in the way of results. But like I said, we'll talk more about that on the next slide.
And disputes can cause you severe problems if you get that wrong.
It can do, and this very much depends on your industry. I mean, for instance, if you see many white goods that you see in your local electrical store are sold on sale or return, so and there can be enormous percentages of these goods are returned. So you don't actually, and you have to process those disputes very quickly, or else ultimately you don't get paid. If you look at deductions processing, which is kind of more common when you're dealing with retailers or in the US, that can be an enormous process, millions of transactions, and you have to have, you could have a customer who pays you on time, relatively speaking, but there's loads of deductions, and so your problem isn't necessarily getting paid late; it's that you have an administrative nightmare just trying to deal with all these things, and ultimately, companies should have some kind of issue eradication program, because if the same mistake's happening over and over and over and over again, I mean that's it's pretty stupid, really, because the idea should be that over time people are ironing these problems out of their businesses, and that's how you get more efficient and better customer service.
And cash application, again, can be internal problems in terms of the structure of the process, not the automation, but the structure of the process.
Yeah, I mean, the very simple example these days is it's great getting electronic information from the bank that tells me which invoice was paid, but is the information that the bank transmits to me sufficient so that I can actually allocate the thing properly? Now, in most cases, it is, but you'll find that depending on what country you're in, what currency, what bank you're dealing with, that can be, and also internal routines. And this is actually an area that a lot of automation activity has gone on over the years.
Okay, so if we look at the segmentation, customer segmentation, you have this point that one size doesn't fit all.
Yeah.
Can you explain?
Well, there's two dimensions to this, just to explain the grid. The 80-15-5%, that's looking at the value of turnover in the total pie. So the top three boxes represent 80% of revenue. So the traditional thing would be you concentrate your activity on your high value customers, which generally speaking does make sense. That also means that with the smaller customers, and you see that the number of customers goes up dramatically as the size goes down. It's standard Pareto rule. But what it also means, if I have that team of collectors on the phone, they're not capable potentially of phoning thousands of people. So you have to be quite selective about, I'm going to call a set of customers versus I'm not going to call a set of customers. So an example would be you're definitely going to be on the telephone with the top 80% by revenue, but with the next two, there I may have more automated routines, such as dunning letters, reminders. You see with mobile phone companies, they'll send you a text and things like that. But the second dimension then is payment behavior. So we all have customers who pay us early, which is great. Wish we had more of them, but that's life. We have people on the other end of the spectrum who pay us very late, regularly late, and you'll find that you then get customers who pay us a little bit late. And actually, the most difficult box to deal with here is your A2 group, because they're large customers. They pay 4 or 5 days late. That might be because they're paying you on a weekly cycle or something like that. But the problem is that this is an awful lot of money, and that's why I've calculated here. You'll see this cash flow cost stroke gain. So those people who are paying you early, say in that A1 box, in this case, and by the way, this is real client data, although I'm not going to tell you who, because 2 billion euros worth of sales are paid early. That is worth nearly over 23 million in cash flow, which is great news. But in the A2 box, you see a lesser value of sales actually loses us 24 million euro in cash flow. So they kind of cancel each other out. So really the game is you want to maintain the early payers and reduce the later payers. Now, the second point, if we talk about automation with the lower value customers, and again, I mentioned mobile phone companies. If you look, say, the C1 box versus the C3 box, it's very common with mobile phone companies that for some reason, if you forgot to pay your bill or your direct debit failed or something like that, and you are a customer who pays regularly, they'll simply send you a text to remind you to say, if something went wrong, it's probably just a mistake. We're just telling you about it. So they differentiate those people who are regular good payers versus on the other side, they might say this guy's a continually delinquent customer, and they'll say pay it within 7 days or we'll cut you off. So you can use that kind of automation to differentiate between how you want to respond to that customer behavior. And that's really where automation can play a big part, because there's huge volumes of customers here. And again, just sending one set of messages out tends not to get you the results that you want. And it can be expensive too. I mean, if you go back to utilities, when utilities send you out your red letter, that costs them a lot of money versus someone who paid the bill first time without being asked.
One of the key decisions, business decisions, is customer segmentation in terms of receivables, rather like this grid here. How often do companies do this?
My experience is there's probably about 20% of companies who do something like this. The vast majority tend not to. The vast majority tend to focus between high-value customers and low-value customers. I'd say an increasing trend, particularly when you're talking about accounts receivable software, they tend to focus not on payment behavior, but on risk, which is I'm not saying you shouldn't focus on risk, because it has its place. But my experience would be that actually focusing on payment behavior actually delivers more cash in terms of focus on collections than doing this based on risk. Because I can have someone who's got a very high risk rating could actually be a very good payer, and vice versa.
Yeah, exactly right. So if we wrap this up, what would be your overall comments?
I think firstly, as the heading says, you have to get the basics right. If you get the basics right, you get lots of different options, particularly around software usage, automation, so on. The second point is what I call the busy fool scenario. So you can go to a lot of collections departments and they're very, very busy, but that doesn't necessarily mean that they're reaching their targets. And that's oftentimes not because people are silly or anything like that. It's because they're doing an awful lot of work focusing on the wrong thing. And if they focus on the right thing, and they have a methodology which tells them what to focus on and what not to, they would actually get much better results.
So you've got to be selective in your use of automation, but first you have to get the basics and the business model right before you look at automating.
Yes. And there ultimately can be a problem that if you haven't sorted the basics correctly, and then you introduce automation, automating a poor process usually is not a good idea of any process.
Absolutely. That's life. Thanks, Brian. Really interesting.
Okay, Jack, thank you very much.